stay the course until the job is done. There. That's really all that Fed Chief Jay Powell committed to today. And while Wall Street hated it, with the Dow plunging 505 points.
Today, folks, Papa Powell, the Federal Reserve wants to destroy your assets, your stock portfolio, your real estate. They don't want you making money, because when you do, you be spending money and you be taking inflation out of control. They have a plan. They're sticking to it. If you're part of our chat groups, you're generally in the community. You're scrolling around in your portfolio today seeing, oh my God, Apple, Google, Amazon, everything is down like 4%. Mega caps trading like penny stocks. This is the new reality that we just have to live with. But this gets me motivated. It sinks to the bottom of my soul. As much as I love seeing my portfolio going up, when things drop, I get motivated. Motivated to sell my Jordans, motivated to sell my custom merch from podcasts that I used to watch, and damn it, I will liquidate my bed and my furniture if I get some capital to invest in these damn markets. Today, we're talking about one particular sector, and that's going to be real estate investment trust here, folks. There are two sectors right now, in my humble opinion, if you're looking for dividends, passive income, insane cash flow with real potential of growth moving forward. That is in banks, and that is in REITs. Banks, take a look at the Canadian banks, for example. Canadian Imperial Bank, Bank of Nova Scotia, yielding over 5% dividend yields. The largest bank in Canada, Royal Bank, is damn near yielding over 4%. JP Morgan, all these stocks are completely in the toilet, paying higher dividends than we've seen in the last 5 freaking years. And they're the only industry that's actually going to dominate and benefit greatly in 2023 off the interest raising environment. Higher interest rates go, the more money they're going to make. I'm promising you, buying opportunity of a lifetime, but not official financial advice. But REITs is what I want to focus on in this video, because taking a look at my portfolio here, guys, I put so much money into VDY over October, which is just a Canadian dividend ETF with over 50% exposure to the Canadian banks. I got my bank exposure. I want a better diversified REIT portfolio, so I'm looking at scaling down Riocan and Smartcentres only by enough that I can still have enough shares paying me out per month that I can reinvest them with that drip. We can see that actually within this account here. I'm pretty much flat between the two positions. Well, actually, I'm down now because they've tanked in the last week here. Riocan, Smartcentres. I'm going to cut them in half, and I'm looking at adding 2 new REITs, and I'm going to talk about the REITs in this video and why I'm focused on individual REITs over an ETF. I know a lot of you say, why don't you just buy an ETF? Well, we'll talk about that. But again, if you want to support the channel, support my sales, support my hustle, damn it, you like my portfolio overview here, I always recommend going to the portfoliospreadsheet.com. It's my custom spreadsheet. First and foremost, what I like doing is going on the stock screeners on Yahoo. So we're looking at real estate, specifically mid-large mega caps that are paying over 4%. And again, you scroll down the 52-week low from the very tippity top mega cap companies like Crown Castle, they're all mostly trading at 52 weeks low. And one of the favorites in the dividend community has to be Realty Income, and they posted some earnings I got to talk about in this video here, folks. But even from the Canadian side of the border, it's just a great screener to give you a quick idea of what you can be looking at for the mega cap REITs that are yielding really great monthly distributions here. So we'll talk more about the Canadian REITs in a second. Let's talk about Realty. This thing is a gem, an aristocrat in the S&P 500 and a fan favorite of the dividend community, which is trading down 13%, but today actually jumped up, is green on a day when the market's getting devastated. Their yield right around 4.8, sometimes when they dip, hovering around 5%. So why is Realty up? Well, they crushed it. They did so well on their earnings. Maybe crushed might be an over exaggeration, but they did great. And they increased the dividend for the 100th consecutive quarter, man. Let's take a look at that. The quarterly dividend increase in September, representing a 5.1% increase compared to the amount declared 1 year ago, is the 100th dividend increase. Funds from operation increased to 9%. But I want to dive into this because if you don't know Realty Income, they're a good exemplifier about the broader retail sector in the US with over 11,733 commercial real estate properties. I don't even know how you can manage that. That's absolutely nuts. With their top tenant being Dollar General, Walgreens, 7-Eleven, guys. Grocery stores make up a whopping 10.3% of their entire portfolio. This is very, very diverse. This thing is just a conglomerate in its own right, and for the first time in a while is almost yielding 5% when it hits those dips. Now, they are doing more share dilution. I don't pertainably like this, but they've done a good job with the equity. Apparently, they're raising $2 billion of equity during the quarter, with $1.3 billion of which is intended to settle in the fourth quarter at $66.70 per share. So where they even liquidated last time, guys, which again, it's annoying. It's another reason the stock's probably been going down here, and I don't like when they're liquidating in a suppressed market. It's not really good for shareholders. However, something positive in the rental revenue is pretty intense here, because I don't know if it's through acquisitions, selling of properties. I don't know what they're doing, but the revenue went from 486 million to 825 million just for the quarter in rental income, which is nuts. And everyone's talking about interest rates and expenses, and we can see that their interest rate has also gone up a lot from 76 million to 117 17 million is insane. But again, you don't know if that's from acquisitions, expanding the company with the share dilution. There's a lot to understand on this balance sheet, probably deserves a deeper dive, but just look at the dividend increases here, guys. Oh, Realty is a beast. You know, we're not talking about the craziest dividend increases. I think over its history over the last 20 years has been compounded at something like 4.8%, but still really, really good dividend growth across the board. Let's talk about Stag Industrial real quick. Stag, guys, paying 4.66% dividend yields here. This one I thought would get crushed. It's an industrial REIT. If you haven't heard of this, guys, take a look at their tenant bases. Amazon makes up 3%, their largest tenant. And we all know Amazon went on a canceling spree of logistics centers, but I guess because these leases are locked in, they're doing very, very well, which we'll see in the rental revenue in a sec. But we can see air freight and logistics make up 10.9% of their industry exposure, with containers and packaging at 8.2%. So this company has a real good foothold in the logistics arena per se. But take a look at the growth here. Rental income, guys, from last year was 140 million to 164 million for this quarter alone. I don't know how they're doing this. I'm very impressed by this. And Stag is just another one of these stocks, guys, that I would be paying attention to if you're looking for great cash flow and future potential growth. And coming to the Canadian side of the border with logistics, this is just painful. So I got to really pay attention to these earnings because I want to add some logistics centers. But look at this. Dream Industrial is paying 6.31%, down 34%. Granted, literally one of the largest REITs in Canada, one of the most pronounced, has done fabulously over the last 5 years. Year to date, down 32%, 4.42% dividend yield here, guys. What else we got? Summit REIT, another industrial, trading down massively, 21%, 3.2% starting dividend yield. So we got Riocan posting tomorrow morning. It's trading down 16%, actually outperforming the S&P 500 this year, 5.3% dividend. Really juicy stuff. You know, I talk about Riocan a lot, so we'll save that one for tomorrow. We got Smartcentres here as well, paying now a 7% dividend yield, down 17% year to date. Just crazy. So why am I looking at all these different REITs, guys? Because I'm going to pick my favorites. And like I said, I'm going to scale down the ones I have and continue to build a diverse portfolio of REITs. I want about 5 of them with an exposure of about 8 to 10% of my entire portfolio. I just want diversity and stability in my cash flow. And that's always going to be the end goal and game at this point. But I want to do it with stocks I trust and I believe in. So why not pick ETFs? It's the easiest way to do it. I mean, Horizon's equal weight Canadian REIT ETF. It's probably been one of the best performers. And the reason it's been one of the best performers is because it's an equal weight ETF. It doesn't top weight anything. So if something gets hit heavy, it doesn't really experience it across the board. However, the other reason this is a great ETF is because the expense ratio is incredibly low. I think the expense ratio is 0.3%, probably the lowest amongst most of the ETFs. I just don't like this ETF because when I look at the top holdings here, and again, it's pretty much equal weight. I wouldn't say top holdings, but First Capital, Broadwalk, Primis, Inner Rent, you got Smartcentres down here, like just REITs that I've never been that appealed by digging through their history. A lot of them trading down pretty dramatically. I mean, Canadian Apartment Properties is even farther down the list here, and it's Canada's like largest apartment REIT. Like ZRE, for example, is another one of these really good pronounced Canadian REIT ETFs. But the problem is I don't like this one either because the fees on it are insane, guys. This one is double that of Horizon's at 0.6% expense ratio. So you're getting a 5.22% dividend that's paid monthly. Yeah, who cares? You're going to be losing how much of that? On 10,000 invested, you're paying $60 a year just to expense fees. You still got to be careful with them REITs, but I still think management's probably the biggest hindrance to most REITs. So you kind of want to just diversify that risk a bit and look at these crazy suppressed prices and these wonderfully high yields across the board. And I'm looking for some juicy monthly passive income here, folks. I want to know what REITs you're buying. Help me out here, damn it. Tell me what Canadian REITs interest you, what US REITs interest you the most. I mean, there's so many of them that I'm just starting to explore, and we'll talk about this more tomorrow.